Hello, everyone. Welcome back to the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast, and I'm absolutely pumped to be with you here today. This is episode 129 of the PetroNerds podcast. Today is April 2nd, 2025. This is also known by the Trump administration as Tariff Day or Liberation Day, and there's a lot within the tariffs, and I am going to spend the introduction of this podcast talking about tariffs. And I'm going to say some things that are probably controversial for people to listen to, which is that Donald Trump did more today against China than any leader has in a really, really long time. Might have done more to actually combat against China than any U.S. leader has since certainly since we opened to China with the World Trade Organization. And I say that being someone who has actually felt the brunt of Doge, who is part of this economy like anyone else. But I spend a lot of time on China. I spend a lot of time on energy, and I can tell you that what China has done to the U.S. in unfair trade practices is what China does, is how they decimate competition. And so if you actually go through the tariffs, but importantly, if you actually read through the executive order, so much of it is actually about manufacturing, and it's about actually security and national security. And the actual tariffs talk to that. So I'm going to introduce this podcast, and with this, we're talking about tariffs, but this podcast was actually recorded on January 16th, 2025. I think this is extremely timely, folks, because this is right before Trump gets into office. I think this is a great time to sort of assess where we started and where we're at now, because the world has changed a lot. Certainly, oil prices have changed a lot, about $10 since January 16th. But at $79 a barrel on January 16th, they should have never been there in the first place. But you did have a lot of unwinding of short covering and those sanctions that were placed on Russia that were not actually implemented. So this conversation, this talk that I gave at the Denver Earth Resources Library, which I'm on the board, so I'm super pumped about that. But this was for the Denver Association of Petroleum Landmen, or DAPL, and this was on January 16th. And so this is a complete market overview. And I spent a lot of time up front really going through what is going on at the time, talking about Chris Wright's testimony of his initial hearing before he becomes the official Secretary of Energy. And so I talk about, one, the state of the health of the economy at the time, the anxiety sort of around the economy, and also the optimism sort of around Chris Wright in energy and things like that. And so I think it's really important to just keep this in context and this in mind. And this is January. And I think a lot of sort of the nervousness and anxieties of the economy, especially on inflation, have really been pulled forward. But I think what you'll see clearly within this presentation and talk is that these instabilities with the economy, particularly inflation, were present well before today, the day of tariffs and this so-called Liberation Day. So keep just putting that in mind. Now, today, oil prices are sitting at $69.31. We saw almost $72 a barrel before tariffs were announced. And you actually saw the stock market, interestingly enough, you saw the stock market kind of rally before the announcement. And I think that's because they were maybe hoping for something better than they actually got. They were certainly hoping for lower tariffs. They were hoping for maybe a 10% tariff across the board or something like that, or targeted or specific tariffs, and they didn't get that. So they got massive tariffs at 10% across the board on everyone, and then significantly higher tariffs on others. And I'm going to talk about in a second of why that's a very actually, it's an opening salvo. And so a lot of the impact to the stock market and the economy is going to really depend on the duration of these tariffs. But with that being said, so we are at $69.31. So we're literally $10 less than we were when I gave this talk that you're going to listen to at $79 a barrel on January 16th. Brent is $72.55. We have Henry Hub just below $4 at $3.99. We've got the Dutch TTF has risen a little bit. That makes sense given we saw the upward pressure we saw in the last couple of days. Excuse me, on oil prices. That has really been because of Trump's tough talk on Putin. And because on Sunday, he said that he was, quote, pissed off. I'm using that word because that's what he said. He was, quote, pissed off at Putin. And so that we would potentially be implementing more sanctions on Russia if they don't agree to the ceasefire. Well, they're not seeming to really want to play ball. So that's what helped put oil pressure up a little bit. We've seen that obviously sell off since the announcement of tariffs and move down. But this $13.16, this little upward pressure we're seeing on Dutch TTF or European natural gas prices also makes sense in the context of, hey, we might not have the ceasefire. You might not be lifting sanctions on Russia. You might not be getting natural gas molecules flowing into Germany anytime soon. the fact that they're even thinking about doing this is pretty insane to me and bananaville, given the incredible risk and exposure they had to Russia in the first place. But this is Germany and this is Europe. Okay, so this is what they're thinking. 10-year yield, we've really seen the 10-year yield come down. So we're looking at 4.062% on the 10-year yield. That is super interesting in the face of what we're seeing with tariffs and the sell-off. Now, I'm not advising people on stocks or investments, but it is important to put this out. I think Morgan Stanley has been on the record, and they have been talking about this. And I spoke about this at Colorado School of Mines yesterday and talked about some of the commentary you're hearing from folks is a lot calmer than the rhetoric you're hearing on the stock market. Morgan Stanley is one of those where they're saying, hey, this this sell-off and the duration of tariffs, or one, the sell-off is a little overdone and the duration is what's going to matter. They're a little more optimistic that the market gets certainty and that things move back into more of a normal territory. But putting that in context, the Dow is down almost 1,000 points. Now, really important to put that in context. Okay, 1,000 points, super scary. I'm sure people are nervous about their retirement and their portfolios. But I want to remind people that there's so much more money in the system, that $27 trillion of global economic stimulus that is now, a lot of that's in the stock market. When you have low interest rates and you have nowhere to put your money, you put it in the stock market. And so a lot of folks have their money, and a lot of we have basically record high retail traders in the stock market right now. So they're open to that volatility now. And obviously they experience volatility, but they can also exacerbate that volatility. But importantly, Dow's down 1,000 points. It is only down 2.33% today. So 2.33% doesn't sound like as much. And I'm only saying that in context of, not that this isn't bad and not that this is not going to impact trade. I'm saying that we've had a massive, massive rally on the stock market. And so these sell-offs, because we've just been up and up and up and up year after year after year, that's not normal. And you have to have healthy sell-offs. Now, today you heard on CNBC, if you were listening, around 11 to noon, you heard folks like Kelly Evans talking about her anxieties and putting lots of money into the market and having the potential of a lost decade and not having returns. And that's something we all have, right? We're all fearful of putting our cash into the market. I'm certainly one of them. But this is a reality of that. They were at least talking with somebody with Northwest Mutual today saying, yeah, if you're looking at this and you're saying, okay, stocks never go down, which is what so many people have experienced as of late, that's just not the reality of the stock market. The reason you're paid to have them, or you do it in the first place, is because it's a risky investment and not everyone is going to do it. And so when you have lots of money sloshing around the system, retail traders, it tends to end up in the stock market. And this is just reality. Now, getting to tariffs and why we're seeing the sell-off, this is really important. And today I'm going to focus mostly on China. And the reason I'm going to do that is because I do think that, and the reason if I sound kind of giddy and optimistic right now, it is because of what this administration just did to China. I have been waiting for an administration to take China seriously and to take this threat of China and understand the importance of manufacturing, not just from we need to bring the jobs back to America, but from the fact that when the way China competes is not the way we compete. Our companies compete on profitability. You cannot compete with China if you're worried about profits. You can't compete because China throws everything in the kitchen sink at a problem, and they subsidize everything, and then they decimate competition. So it is important to autos. It is important to jobs, but importantly, it's also really important down the road for when they want to do something bad, like engage in conflict, and you are unable to bring your private sector or anyone involved to actually help you build ships and help you build tanks and help you build ammunition or anything. That's really, really serious. And that's what the actual executive orders actually speak to, is some of this language of rebuilding the industrial base so you have it in the future within the U.S. economy. So looking at the actual tariffs. So I'm looking at these sheets. So Trump held up I listened to his entire speech. I will say he got a lot of positive sentiment from the unions. And he was handing out a hat or two, but he gave a thorough speech. And I want to point this out. I do think this is a really clear way to start negotiating. So there's a lot of criticism of these tariffs right now. And I'm holding the sheet up because looks like the billboard that he put up, and there's two of them. Most importantly, and we'll get this we will go into tariffs in more specific detail in future podcasts. I'm going to be doing a hot take with Jason Isaac. We'll be talking about this because I'm the economist for the American Energy Institute. But I want to point out that the first one, so the big billboard that he was holding up, there's two of them. Canada and Mexico are not on here, but the first one is China. So basically, it lists the first column and it says tariffs charged to the US. So effective tariffs. 67% is what is charged to the US effectively from China. So basically, it makes it very difficult for our products to enter China, right? We can't really sell our products well in China. Well, that's kind of a big deal because for the last 40 years, that's what China has told us. And that's what all the companies that have, from the US and elsewhere that have wanted to invest in China, that's what they promised their shareholders. That's what they promised the American people is, oh, but we're going to have such a market share of these 1.4 billion people in China. Well, that's never actually panned out. And lo and behold, China doesn't play by the rules, and so they don't play by the rules of the World Trade Organization, which they entered. We allowed them to enter in 2001, and since then, our manufacturing has declined, and theirs has grown. Now, theirs has always grown, and this was always the plan, but it's an unfair, unbalanced playing field in terms of competition. I am saying this more. It's not just about T-shirts, but we are going to hit the T-shirts, and I'm really excited about that as well. So the reality, though, is this. So you list this tariffs charged for the U.S., 67% by China. So the Trump response is a USA discount or reciprocal tariff. So reciprocal tariffs are saying, we're going to slap onto you what you have to us. He actually cuts this. The Trump administration is cutting reciprocal tariffs by half. So making this very clear that saying, we're going to be fair. You have this tariff on us. We're going to cut that by half and implement that on you. That is a great way to get every country listed on here to the negotiating table to say, remove your tariffs on us and we will remove them on you. So I hate to break it to you folks, but this is what this is about. This is about realigning trade in the world, and just listing out the fact that it's listed on paper. How awesome is that you know what your tariffs are being charged? And it's an exorbitant amount. Now, so for China, when I say that this is tariffs, I've said on record multiple times. I said it at Colorado School of Mines. I said it at the Houston Producers Forum. You're going to hear a lot in future podcasts when those drop, is that I talked about if tariffs are not about China, they damn well should be. And they are absolutely about China. And that's what we heard today. And that's why I am not excited about the pain to the global trading system. I'm not excited about pain to people's portfolios. I am quite excited the fact that this administration is taking China seriously, because they charge us 67%. So Trump has said 34% reciprocal tariffs. This is actually on top of the 10% and then the other 10%. So we are looking at a 54% tariff on China. Now, importantly, they also put an order on the de minimis rule. So an executive order came out on the de minimis rule saying they are removing the exemptions for the de minimis rule. And now everything coming through from China, particularly from China, but the de minimis rule, which is packages of $800 per day per person, are going to be charged tariffs, that's just great from a regulatory standpoint because it helps prevent it. It actually does help look at the fentanyl crisis and how stuff is getting through the borders when they're coming through Mexico. So the de minimis order is going to be in effect. And so that actually takes effect in May, I think. But that means products from Shein, from Temu, from all this cheap, fast fashion stuff that's made with forced labor, that's made with coal-fired power generation, this rock you see above here, that coal, that's actually from Wyoming. That is all going to be, that's all going to be quelled. Now, importantly enough, and I think this is so important to point out, I'm going to list a couple more of these tariffs, but really important is Taiwan. So Taiwan is listed on here. And the immediate response, and I'm just listening to stock market coverage. I had a lot of calls today, so I didn't get to watch it live. I watched the Trump speech after, and then I've been listening to stock market coverage, and I've been printing this out and getting the numbers for you. But so you would think that China's response would be, oh my gosh, 54% tariffs, that's horrible. What are we going to do? Or just put something pithy out and say, you slap us with tariffs, we'll slap with you, whatever. They didn't actually respond to any of the tariffs. What they responded to was the fact that Taiwan was fourth on the list and labeled and listed as Taiwan. And it wasn't Taipei, it didn't say Taiwan. So basically, Trump talked about Taiwan as a country. That is what pissed off China the most. And quote, I believe it's Feng, sorry. He's the Chinese ambassador to the U.S. His name is spelled Xie. The last name is spelled Feng. So I'm pronouncing that horribly. I apologize. But he said, quote, Taiwan is China's Taiwan. That is what they are most upset about. In all of this, they are upset of not of the tariffs, but the fact that Trump called Taiwan. And as though it's a separate country from China. It is a separate country from China, folks. we've played this ambiguity rule that, China's part of China, or it's not part of China, and so we pretend that we don't know. It is a separate country for all intents and purposes, folks. But China doesn't want anyone to say that, because they believe they will reunify with Taiwan. They hope to do it peacefully, like they did with Hong Kong, which wasn't peaceful. They just did it over COVID. But that's what they want to do with Taiwan. So very important to point that out, that we're talking about this. And so I think the stuff on China is really serious, really, really importantly. And the last thing I'll close with this, because this is a great summary of the world that you're about to listen to on January 16th. And it's a nice recap and puts everything in context that we're dealing with today. But next on the list, European Union. The effective tariff they have for U.S. products is 39%. So we put a reciprocal, cut it by half of 20% on the European Union. Vietnam, that's the biggie one here. Vietnam and Taiwan. Now, Taiwan is about chips. And I'm a little bit, I'm not as in big a favor as tariffing Taiwan as the Trump administration is. I do think we need to be protecting Taiwan, and I do think we need to be investing in Taiwan for a number of different reasons. But Taiwan is at 64%, so we put a 32% tariff on them. They are investing chips. They are investing here in America. And so I think it's really important, folks, for you to appreciate that this is the opening salvo. It is very clear. So it lists, hey, these are what your tariffs are on us. We are cutting that by half, and then we're putting them on you. And now we have a negotiating stance, right? We know where we're at, and now countries can negotiate. And so that's what's going to happen. They're going to say, we will lower tariffs on you if you lower them on us. And this should have honestly been, this high of tariffs from so many countries on our stuff should have been addressed a long time ago. It's a lot to take in all at once, certainly for the stock market that's down 1,000 points, but that's because it hasn't been addressed before. So I will just note also that Vietnam is 90%. That's what their tariffs are on us, 90%. So we are putting a 46% tariff on them, and thank God, because so much of the crappy Chinese stuff, especially solar panels, is coming from Vietnam. It is really, really important to address this, folks, because if we put if we do all these chip controls and we do all these sanctions and we do all this stuff on China of limiting this high-tech stuff, and they just make it and it just goes through Vietnam, and then it gets dumped on us of these cheap products, which decimate our competition. And I can't underscore this enough, folks. This is not necessarily about bringing just manufacturing jobs back to America. This is about being able to compete just day to day. So how can you compete how can a normal company in America or anywhere else compete with Temu, for that matter, when you're making it with forced labor and you're making it really, really cheap and you're dumping a $3 t-shirt on the market? You can't, right? You're not able to compete. And China does not compete the way we do, right? We think about labor and energy as input costs to lower costs and to impact profitability. They don't think about it that way. They think about in the long term, where labor and energy are inputs to enable competition, enable them to decimate other competition. So with that, folks, you can tell I'm riled up. I am passionate about this. And we're going to spend more time talking about this. So I wish you all well, and I can't wait for you to listen to this conversation. I am so pumped about it. And there's lots coming down in the queue, folks. We have conversations about national security that I gave to the Eisenhower School also in January, which will drop. I just spoke to the Colorado School of Mines yesterday on April 1st. That was a blast. I will be going back to Texas Tech because on March 24th, they had a power outage, so I didn't get to speak and I had to come back. But I will be going back to Texas Tech, going to Lubbock. I will be speaking on April 16th, so I'm super pumped about that. I'm headed to Montana Tech, and we'll be speaking. I'll be the opening keynote speaker, actually, at the Montana Tech Symposium on April 10th, so I'm delighted to be there. So there's just a lot going on in the market, folks, a lot that PetroNerds is going on to speak about, and I couldn't be happier to be in this business right now and to be helping folks. So guys, reach out to me directly, reach out on LinkedIn, reach out on my website, and just know, get PetroNerdy. PetroNerds has you covered, and knowledge is power. So talk to you soon, folks. Awesome. Thank you guys so much for being here. I know it's early morning on, I guess it's Thursday. We are 2 weeks into 2025. So I'd like to say I have 30 slides, and we'll take it easy, but we're probably not going to take it easy. I have way more than 30 slides, but I can go through things pretty quickly, as you probably know. So thank you so much for being here. I do want to mention really quickly, I am on the board of the Denver Earth Resources Library, so I love that DAPL is using this space. I know we have this pillar in the middle of us, so I apologize for that, but I can move around. You cannot have the slides, but you can talk to me. I will be recording this, so you'll have the audio, so even if I talk fast, you can probably play it back a little slower. But I love this library. I am very proud of, or really happy to be on the board. Amanda Cohn does an amazing job with this library. It's probably one of the most affordable places for for industry or anyone to actually have a meeting. It's beautiful. It's nerdy as hell. And I mean, I love the rocks. I love the geology. So I can't say enough good things about it. So if you're not involved, please get involved and please use the space and reach out to Amanda or myself. But just want to thank her and thank you guys for using it. And I'm really, really delighted to be with you here today. So we're going to play this by ear a little bit according to your body language and how interested or not interested you are into the material. And it is early in the morning. So we're going to dive in though. And this is the outlook for 2025. We're literally 16 days in, and I have been ripping through all kinds of data in preparation for this and other meetings. And I can tell you it's a pretty mixed bag. I can't tell you with any of the data points that I am like, wow, the global economy is amazing. Actually, all of them the global economy looks pretty terrible. The US economy looks okay, like it's holding in there, but there's a lot of data points where things look like they're about to roll over. I will say that listening to Chris Wright yesterday at his hearing and testimony, that really did make me optimistic because it kind of reminds you why, what he's talking about and what the Trump administration is going for, especially for energy, which is lowering energy costs and bringing manufacturing back to America. That is all bullish for America. But that being said, I think we have to put that in context. And it's not that I am not optimistic about that, but I think we have to talk about that sort of optimistic uncertainty, and I'll get into the weeds a little bit about U.S. shale. So we have a lot of ground to cover. If you haven't listened to the podcast, I really encourage you to do so. It's a wealth of information. Obviously, it covers only, kind of a snippet or sound bites in many ways of what I do with clients. But if you like that, you will definitely like working with me because we get deep into the weeds. And today, you guys get to experience some of the getting into the weeds. So biggest takeaways, I'm going to start out with a lot of the answers. I'll front load it, and then we'll go through the slides and the data points, and according to time, see how much time we have and what you're most interested in. And then we will open it up for Q&A, which I encourage you to, throw some curveballs, ask hard questions. Look forward to chatting with all of you. So 2025, absolutely volatile. I would say that's the best way to describe it. I can't say that last year was, wasn't unvolatile, but what we're seeing this year is several things, which is oil prices are high. I do not think the stock market is appreciating that, touched $80 oil yesterday. We're at 79 this morning. For WTI, $80 is pretty high. Historically speaking, that's high, but right now it's really high because the global economy can't really handle that. So the cure for high oil prices is usually high oil prices. And I think people, at least the market analysis, is not covering that right now, that these prices are probably too high. Part of that's because they're very focused on the Fed, they're very focused on inflation, they're very focused on yield curves, and they're very focused on the Trump inauguration next week and how essentially everything that you're analyzing right now is going to have a lot of question marks put in it according to what happens on day one with a lot of executive orders and everything coming down the pipe from the Trump administration. But oil prices, I would say they are too high. I do not think the global economy can really support these prices for an extended period of time. And if they do, it's just weakening and eroding things further. And you'll see that really in the data. The UK is not doing well. Germany is not doing well at all. There was a great Financial Times article out today that has some awesome charts of just how bad Germany is doing. One of the big things is clearly electricity prices, that they're more than double our electricity prices. And that was just from last year alone. So, I mean, the weight that they're in their second year of recession, and that is your largest economy within Europe. So if they're not doing well, and if you have some sticky and persistent inflation and your economy is declining and unemployment's rising, that's not called just recession, that is getting to the territory of stagflation. So, the Fed has also put a lot of volatility into the market in the past 2 weeks, really, and that's because the Federal Reserve released their minutes from their last meeting. And so I have been very open about this. If you've listened to me on podcasts or me speak at presentations with clients, or if you've just seen my LinkedIn posts, the Federal Reserve has cut interest rates aggressively in the face of an okay economy, but more importantly, inflation. Like, the economy actually probably needs to decline. We need some correction in the economy because we have not solved inflation. And inflation is just beating up the average consumer like crazy. And so the inflation read came out yesterday, and the market just cheered it because it was 0.1% lower than expected. 0.1%. That absolutely means nothing. And so it's very exhausting to watch the stock market and watch analysts talk about this 0.1% as though that matters to the average person, because it doesn't at all. And so the Fed, I feel like they're in a bubble where they just hang out in DC and they hang out in New York so much where they're with all these wealthy people, and they don't realize how the average person lives. And the problem is they have cut interest rates 100 basis points, half a basis point in September, which was really aggressive, and then 2 more before the end of the year.
And actually, the yield curve, 10-year yields, treasury yields, have went up more than 100 basis points, which are tied to the 30-year mortgage. So their hope was they would decline mortgage rates, they would decline all this stuff. Well, when you have a house that costs $500,000 on average in the U.S., and you have over 7% mortgage rate, you've done jack all for actually inflation or cooling anything off. And so that we saw that they clearly cut interest rates too soon, and then we have the 10-year yield rising, and so now we have the 30-year mortgage back up. And so that volatility in the market, what happened was within their Fed minutes, they talked about Trump specifically. And that's a really big deal. You're not hearing a lot of coverage on that. Bloomberg has done a little bit. Mohammed Al-Arian is someone that has been talking about this as well. And so you actually have people saying, hey, you cannot have it both ways. You can't say during the Biden administration, we didn't talk about politics, we're not going to talk about fiscal spending, but now, before Trump's even in office, that's what we're going to talk about. And so they have pushed the yield curve back up. And so it really looks like it's very messy at the Fed. It doesn't look like they have a clear line of sight on what they want to do, how they're doing it. And that makes sense, right? It is a tough job, but there's a lot of mess right there. So with that, like the U.S. and the global economy, the U.S. is still that bright spot. And you have to always put that in context that the U.S. is always the cleanest, dirtiest shirt in the closet. So this was the case in the 2008 financial crisis. It was the case in the dot-com bubble. It was the case in 1998 in the Asian financial crisis. It is always the case. And so we are in a pretty good position in that we do have we have a very strong dollar right now because other central banks across the world are cutting interest rates, and they still have sticky inflation, and their economies just aren't quite as healthy. Our economy is healthy to an extent, but in terms of growth, which does matter a lot for oil and oil prices, we just don't have that growth story. So you have to put that in context and just have a lot of caveats to that. And Trump 2.0, I think that's the market coverage has been really pretty negative. If you're following stock market and that's largely where people are getting their oil information, the coverage is negative because they believe Trump will be inflationary. And that's what came out with the Fed minutes. That's what's coming out. You're seeing in the 10-year yield. 10-year yield is telling you way more than that. It's not just that Trump policies might be inflationary. It is that we have inflation. And that's what people aren't appreciating right now. Today, 10-year yield curves and 30-year yield curves and 2-year yield curves are telling you what policies are today and all the inflation of actually right now. Policies of tomorrow or next week will be Trump policies, and a couple months down the road we'll actually see what those look like. But the reality is we have a lot of debt. So the U.S. has a lot of debt and the world has a lot of government debt. And so that's what we're starting to see in these yields. And if you're hearing anything like UK trading like an emerging market, there are some serious concerns with that, because as our yield curves have went up and the interest, the payments that people have to make to incentivize people to buy our debt have went up. They went up a lot. They went up a lot for like the UK, and for no reason. Actually, there was no single data point. It wasn't because the government came out and said what they were doing with spending, like when Liz Truss lost her job a couple years ago as the prime minister. It was literally because our yields started rising, their yields start rising, and people start getting a little concerned that they're trading more like an emerging market than an actual developed country. So, as you can see, there's just a lot of I think consternation in the market that we really have to watch out for, and we are literally 2 weeks into the year. I think there's incredible optimism, especially in a room like this and in this library. There's a lot of optimism in the oil and gas sector in the U.S. on Trump 2.0. And I think that optimism is 100% warranted. I am really excited about, from an oil and gas perspective and from an energy perspective, of what Chris Wright brings to the table in just bringing knowledge to Washington. He absolutely crushed it in the hearing yesterday. I mean, how he was talking about nuclear, his grace in dealing with a lot of pretty rude folks, not letting him answer questions, and just the way he talked about the actual data and the actual science on nuclear was extremely impressive. So that's all bullish. And I will say, I don't think the oil and gas sector, particularly, it's been a little bit mute in terms of leaders coming out and talking about, what Trump means for the industry. If you've listened to Mike Wirth, the CEO of Chevron, he has been pretty bullish in terms of what the U.S. production potential means, right? That we actually have a lot of production left to give. Chris Wright has been on the record a number of times saying the same thing, that the rock potential of the U.S. is a lot more than people think. I have been in that camp since I started, ripping apart U.S. shale since 2010, and I do think the rock has a lot more left to give. But that being said, we're at 13.5 million barrels per day, and we're at 13.5 million barrels per day with 200 less rigs than we had in November of 2022. So, and that was, we didn't even bring all the rigs back pre-COVID. So we're sub 600 rigs, and we have 13.5 million barrels of oil per day. And there are a lot of reasons for that, which I'll get into. But it speaks volumes to what this industry does. And that is not appreciated at all within the market. What you guys do, what the industry does, and how it's being done, and the productivity gains and everything. And it's often, I think, a little bit conflated of saying it's sort of basically already done. We're producing 13.5 million barrels a day, and we cannot produce more. And I disagree with that heartily. And I think what you have to think about this, yes, there's a lot of uncertainty from oil companies' perspectives in terms of the oil price trajectory and the macro, and clearly all the reasons I just explained, there's a lot of uncertainty there. But in terms of the certainty of the U.S., when you reduce regulations and you make it easier to do business, not just for oil and gas, but across the board, that's the optimism. That's that kind of bullish fuel that we're seeing when people are getting excited in the stock market, what we saw right after the election. And then within the oil and gas sector, things that people aren't appreciating is just lowering regulations, making it easier to get permits, and also if you have slightly higher natural gas prices. I think we're just not appreciating little things go a long way. And I don't think people also really appreciate the burden of regulations from this previous administration across businesses. There's so many businesses, from airlines to oil companies, you name it, that have put millions of dollars into lawyers just to deal with the regulatory environment. And they are not going to have to spend millions of dollars on lawyers anymore for the regulatory environment, so that money will go to more productive things within their companies. So that's important. But then today we saw BP is saying they're cutting a lot of jobs. So BP said they're slashing several thousand jobs. We're hearing this actually if you're hearing stuff like anecdotally, Apple, Microsoft, a lot of them are saying they're not adding jobs. We heard this a couple years ago. I think this is going to start creeping up more and more. It helps cool off like any inflationary pressures these companies have if there's a rumor that they're going to start laying people off. But it doesn't bode well when companies start saying it, because it can signal like a spiral and people just keep going. So that's something the Fed is a little bit worried about. So wars, geopolitics, sanctions, tariffs. The biggest thing everyone, at least they're myopically focused on Trump, is tariffs. Single biggest thing you hear, which is poorly covered, is tariffs. Of that, okay, Trump is going to induce tariffs. He's going to enact tariffs through executive order, which he can do, and then we will have massive inflation. So we did have tariffs under Trump in Trump 1.0. We did not have inflation under Trump 1.0. And the world is a lot different. We have a lot more fiscal spending in the system since Trump was in office before. So he did spend a lot of money. Republicans spend a lot of money. Democrats spend a lot of money, but they do spend money differently. But no matter how you slice the curve of how much fiscal spending has went up, it's way, way more. Like, just astronomically, if we took the curve that Trump was on and we had kept extending it, we're still much, much higher than we would have been, because we just have this incredible fiscal spending from COVID and all the policies that came after that of in 2021 doing the Inflation Reduction Act, which is just inflationary, several $1 trillion of spending, and you're just throwing money into the economy, and so that's inflationary. So I think that we have to really put this in context of what are the tariffs going to do? You know, how much are they? Where are they put? And are they a bargaining chip? And a lot of it is right now. It is a bargaining chip, and it's getting folks to the table. So the devil's always in the details, and we have to see it play out. But I do think, listening to Chris Wright, I need to listen to more other folks in their hearings. But something that keeps getting echoed is manufacturing and bringing manufacturing home. And so you need to lower energy costs and make sure that manufacturing has access to lots of cheap natural gas to do that. But that also means that you are serious about tariffing on you want to bring business back home. And the way you do that is to incentivize companies that you make it too expensive to be buying your cheap steel in China. I have to tell folks, it is a wake-up call. You shouldn't have been buying stuff from China now. You shouldn't be buying it in the future. And that is the intent of this administration, is that 5 years from now, we are not having this conversation that you were getting anything from China, because I think if you were buying something from Russia, which you probably weren't several years ago before the war in Ukraine, if you were, it didn't matter. Day one of the war, it's over. You're not going to be buying it. So I think we have to, and I'm not being a warmonger or super hawkish on China, although I am very hawkish on China. You just have to be realistic, is that the reality of conflict is high, and so you shouldn't have exposure. That's just not good for business. So we will get into the geopolitics and sanctions. I mean, this administration, again, I'm giving you kind of all the answers here up front, and then I'll get into the weeds. But this administration has a lot of leverage from an energy perspective. more leverage than any leader in world history, because we're producing 13.5 million barrels a day. And that's several million barrels a day more than Saudi Arabia. That's a couple million barrels a day more than Russia. So we have a lot of production. We're exporting a lot of crude, a lot of NGLs, and a lot of gasoline and diesel. So we do have a lot of energy leverage, which means we do have the ability to apply sanctions. So if the Trump administration comes out to the industry and says, can you give me a few 100,000 more barrels, realistically, what would you have to do for this to work? Obviously, $80 oil, that works. He probably does not want $80 oil, so that's a real factor. But we also have to refill the SPR. So there's like a floor on oil if we refill the SPR, and there's things we can do domestically to probably increase output incrementally. And then if you keep natural gas prices up here, you're going to get more production, not just for natural gas, but you're going to get more production for condensate, which there's always a byproduct of, oh my gosh, and we found some liquids and some NGLs, and it just keeps expanding. And so if you think that the acquisition phase or the industry is dead, I guarantee you it is not. We're just in that piece where people just can't see beyond where they're at right now. So there's a lot of leverage there. I think that power generation and demand, really serious to talk about, obviously was, power generation demand in the U.S. is huge. I think something you saw across the board from every analytical group last year was that they missed how big a deal demand growth was for electricity in the U.S. and across the board, because we just haven't seen it in decades. We had pretty flat power generation in the US, but now with AI and now with folks just needing to build things, you need power generation. So it really underscores energy runs everything. It runs the entire economy. You can't have an economy, you can't have a military, you can't have anything without energy. And so this administration, if they really rein that in, they have the ability to do a lot. And I do think the market's not appreciating the leverage you have on energy if you do export a lot of LNG. Chris was asked yesterday about whether or not it was going to increase domestic prices. That really came from that Department of Energy report that came out in December. If you read it, it's atrocious. It's a report on LNG exports and how basically U.S. increasing LNG exports increases CO2 emissions and also increases U.S. natural gas prices, which we know neither are actually true. It lowers CO2 emissions globally, guaranteed, because you're swapping out coal. And we have not seen a statistical correlation. Usually if we're providing a market for LNG, we have 125 billion cubic feet per day of natural gas, so we need a place to go with it. So I just don't think that's correct. But that's how people think about this. China, we will get into that. I think the biggest things to think about China is that the slowing economy. You've heard for 2 years now, China has reopened from COVID and everybody's waiting for the bazooka stimulus package that has never arrived. So China's not demanding the stuff that they were used to. Their economy is not growing. That being said, they're still a very big economy. They're still demanding a lot, but they don't have a growth story, right? They're not going to demand a lot of crude oil. Part of that is because they don't want that exposure on the import side, and there's a lot of stuff going under the hood. I think a lot of what they're doing is intentional. They could fix their economic problems with a bunch of stimulus. They're choosing not to do that. And that is not just because they don't want a lot of debt, which they already have a lot of debt. That's because there's a lot of benefits to actually slowing down their economy. One of them is energy security. They are very tight with Russia. They are the single biggest benefactor of this war in Ukraine. If you look around the world, you see that it's really hurt Europe. It's basically taken Europe out of a World War III, any game plan, because their economies are destroyed. They don't have ammunitions. Their politics are a wreck, and their energy prices are through the roof, and they have no energy security, and they're still hell-bent on the energy transition.
What country you're talking about? Russia?
I'm talking about China being the benefactor of all this. But I'll get into that. I'll show you a little more. And then talked about U.S. leverage. So we already went through these biggest themes. I will just say that think about, too, the extensions of what Trump's going to do of what he did in the first administration. So we have a ceasefire right now that Biden just announced. Now, already this morning, he just announced this yesterday. Already this morning, there are big question marks with that ceasefire because Benjamin Netanyahu is throwing a little bit of cold water on that, and part of that could be the far right within his cabinet and folks around him saying that they're not ready for this to be done. I'm not saying that's definitely the case, but that's what was talked about early this morning on TV. So that ceasefire, you have to always question ceasefires in the Middle East in general, but the ceasefire yesterday that Biden announced, that is, a lot of this impetus did come from Trump saying, literally quote, on TV, saying there will be hell to pay if this doesn't get sorted. So Biden team and Trump team actually work together. They work to get the ceasefire done. If they can get that to hold, that's great. If it doesn't hold, basically Trump's just going to come in and say, Israel, have at it. And that means that you just don't, like, the threatening power of Iran does go down a little bit. Doesn't mean that Iran's not going to continue to instigate and be problematic. It just means that Iran knows that they're in check because the Trump administration is going to let Israel just run wild. I don't think that's the worst thing to do in the Middle East. I know that sounds horrible, but it's just a reality. Like, you need to check Iran. And so we have to sanction Iran's crude. They're already under sanctions. They are just not enforced. So right now, one of the single biggest reasons you're seeing the run up in crude oil prices is because of the new sanctions that the Biden administration put on Russian. It was Russian crude, but it's really Russian tankers and some Russian companies. So it's about over 1 million barrels a day that basically are being moved through these tankers. So the market's saying, oh my gosh, if you pulled it off the market, crude prices are going to go up. Crude prices would go up more if you took over 1.5 million barrels a day off the market. But clearly there were a lot of shorts in the market. So what you're seeing is the unwinding of short covering. And so you're driving up oil price a little bit. So right now the supply and demand fundamentals are not supporting that $80 oil. But in theory, yes, if you really pull off 1.6 million barrels a day of those tankers and Russia can't move the crude, you would feel that. But that means enforcement. So the Biden administration did not enforce the existing sanctions on sanctioning Iranian crude. So we'd have to enforce these sanctions on Russian crude as well. And the bulk of the purchases are going to India and they're going to China. So if you want to go after China, you start sanctioning crude as well. But that means that then you have to talk to Saudi Arabia. And I don't know if you guys have listened, but Saudi Arabia has been very, very quiet lately on any of this. But there's a spare capacity out of OPEC. Saudi Arabia is one of those that, hey, the Trump administration is probably already talking to them and saying, hey, will you increase output? Because if they can't get a deal with Russia and they can't get this ceasefire in Ukraine, they are going to ask Saudi Arabia to increase output. They're going to sanction Iran. They're going to sanction Venezuela. They're going to go after all this, and they're going to put all these guys in check. And then they're going to try to uplift crude from Saudi Arabia. So the Abraham Accords, extending that, I think, is something to just watch out for. That's really just a normalization of relationships between Israel and Arab countries. That is something that we were, again, getting more closer to right before October 7th with the war Hamas and Gaza. But that's all there's big question marks. You're going to see that the Trump administration is going to want to reenact all that and get that going. And going after Iran will be helpful. Saudi Arabia won't say much about that, but they're going to be okay with it because they'll just they don't like Iran either, and if they can take them out as a threat, that would be awesome. Plus, Iran has heavy, heavy influence in Iraq, which means all the work that we did from 2003 onward with the invasion of Iraq, or us going into Iraq, is all moot now because Iran basically controls it. China, that's the other biggest thing, is that tariffs on China, it is a little unclear to me. There are a lot of hawkish China cabinet picks that Trump has. I want to hear more hawkish on China. I want to hear good policies, good rhetoric, good understanding on China, that we understand China is a threat, how they're a threat, and how you go after that, and that you make it difficult for you just don't extend the relationship. You just don't go to China to have meetings. You certainly don't kowtow like Janet Yellen. I want the temperature to change, and I want them to come to us and not us to go to them. And that has been for 4 years. That's all we've done under the Biden administration is us go to China. They send a balloon over our country, and Biden gets scared that they'll get mad at us if he releases the report. I want to see that report get released. I want to see transparency. I want to see about the drones that were probably flying over New Jersey. Those are probably Chinese. Like, there's just a lot of stuff that we need more clarity and good policies on China. And then low oil prices. Trump does not want $80 oil. So the biggest consternation in the market, in the oil market, and with all folks of you guys in the room and every leader and every executive I talk to, is Trump does want lower energy prices. I think, like when Chris Wright was speaking about yesterday, he was talking about lower electricity prices. That's a really big one, right? So getting more natural gas and electricity pool, not decommissioning coal, things like that. But we really need to be thinking about, what is that price level for Trump? We did have much lower oil prices under Trump. That doesn't mean that we will necessarily have that, but I don't think he's going to be a fan of 80. So those are just important things to watch. I think that the tailwinds and the headwinds, I can't emphasize this enough. All the stuff that we heard on, for 4 years, I think people were really, I still hear this. I went to Christmas parties right before the holidays, obviously, and I was a little bit shocked to go to some oil-filled Christmas parties and hear folks still talking about renewables in this kind of the same vein that they were, a couple years ago. And there's a newsflash. I'm not shredding you if you work in the renewable industry, but it is not the same as it was in January of 2021. Like the tailwinds and headwinds have shifted. You are not going to have the money going into renewables. They weren't making money before. They're not making money now. They were doing pretty poorly before we even got Trump elected, and they're going to decline. And so that's really important just to put in context that the tailwinds and headwinds have shifted. American oil is back in fashion. If Trump pulls out of the Paris Climate Accords, which I hope he does on day one, that means that the U.S. is now an investable place to do business. That means that if you want to invest in oil and gas, like just from a publicly traded stock, we're going to pull money from around the world and invest it in these companies, because this is a place that you can, a developed country with rule of law, with the largest oil production base in the entire world, and you can invest here. That is a really, really good thing for the U.S. economy and just for the market and a platform. And so I think that if they embrace that and that works, that's a massive amount of leverage that's extremely positive. So I think you're just going to see an incredible flip in that. And I don't think even the entire oil industry is not quite on board with that yet. Already talked about Chris Wright and that testimony. He just had mentioned affordable, reliable, secure American energy. Keep thinking about these. Affordable, reliable, secure manufacturing. This is something being talked a lot about. So I already mentioned oil prices are too hot. I would just say, stare at the oil price chart a little bit and think about where we were, historically speaking. I had said this at the end of last year when we were at $69 a barrel. That's actually not a horrible oil price. $80 oil is a little too hot, but historically speaking, it is also pretty high. So I think we've gotten a little bit over our skis, and we need to appreciate that all this economic consternation I'm talking about within Europe, the pains that we're seeing there, the pains that we're seeing in China, that is not oil demand growth. So all the reasons that you're seeing oil prices run up right now is because we have concerns about Russian sanctions, we have concerns about sanctions, but it's not demand driven, it's supply driven, and we actually haven't seen any impact to supply yet. And supply shocks never bode well for prices or the economy. So I also think you need to be taking into account where the global economy is right now, where the U.S. economy is, and what a higher oil price means. And it could be, I'm not saying it is, but it could be that thing that pushes the economy on the other side, which is not good. It basically pushes the economy or helps the economy go into recession. So those are the big things that I talked about. That's the sanctions that we've just had. Iran is actually racing to sell barrels out of China, that they have stockpiles in China. They're trying to race to sell those because they think they're going to be sanctioned. Folks, they are already sanctioned. They just knew that day one of the Biden administration, they knew that Biden was going to be lenient on them. So they haven't had any problem selling barrels. Their exports have just gone through the roof. The crude was already sanctioned. It's called enforcing sanctions. And it's something the Biden administration didn't do. And so there's serious things here where, we're talking about just preventing Iran from getting more nuclear weapons. Like, Iran has to be put into check. I think we're going to see a lot of that. But there are huge geopolitical consequences for this. There are huge oil consequences for this. So we need incredible intelligence in Washington right now, and we need people to really, really understand oil and gas. And we absolutely did not have intelligence on hydrocarbons with this previous administration. And then the Gaza ceasefire, which again, that's question marks. Just today, BP said this morning, as I mentioned, that they're cutting jobs. There's a really, really good article in the Financial Times that I just mentioned. Those are just two charts from it that are extremely telling. That's German electricity prices in comparison to the rest of the world. That's just for 2023. So we're at like 18 cents a kilowatt hour. In 2023, they were at like 35 cents a kilowatt hour, which is insane. So that's what you get when you go down the trajectory of Germany, which is you're hell-bent on the energy transition at any cost, and you ruin your grid, and you take out coal, and you put in a bunch of wind, and you don't have any reliable backup power generation or baseload power generation. This is what happens. They also, every data point in Germany is horrible. Their unemployment is up. The actual productivity is down. This is their manufacturing capacity use. They're actually they have all this manufacturing capacity and they're not using it. And part of it's because people don't want to work. They're used to go to Germany and you would get on a train and it was there on time. Now you don't have that. There's another chart in there that shows how trains are not on time at all. We have literally seen the erosion of this industrial heartland of Europe just wiped out in a handful of years post-COVID. So I think they are the sick man of Europe. They're also the largest economy in Europe. And so, you do have to watch Germany very, very closely. France is the second largest economy. They're not doing well either. They've had 7 prime ministers in a year. So, that's a signal. This is from the IEA. I just put this in here because this is the best data point. I'm not supposed to show this, but basically 180 vessels are on the sanction list That includes 160 tankers. So this is the 1.6 million barrels a day. It's very hard to get this information anywhere else. So that's why I wanted to share it. But you can see that like they have this line here for that's Russian crude oil exports that has come down. But Russian crude like production exports have been exceptionally resilient, and that's really important to watch. And I'll show you that as well. Supply and demand, OPEC said this, so this came out yesterday as well. So IEA came out. They're kind of in line with supply and demand for OPEC as well. OPEC is very bullish in the long term of where demand is going to be. I put this Canadian chart in here. You can access this. The OPEC stuff is completely transparent and free, or not transparent but free. That's what they project for Canadian oil sand or for Canadian production. That's just a great example of everywhere outside of OPEC, production has been growing. So we have a lot of supply on the market. I mean, we're gonna clip over 6.2 million barrels per day for Canada, which is very impressive. I think you have to think a little bit like Canada. When you look at all the companies, like they've had a lot of acquisitions and resales. Like they're mainly Canadian companies now. Very similar to what we're seeing in North Dakota, where everyone sold out of North Dakota. I mean, it's not a bad thing when this has happened to Canada. I don't like that now they're exporting crude to China. I think we missed the boat on getting more pipelines built here in America. But that just tells you like Norway, all these countries outside of OPEC with oil prices this high are producing more. So we don't have a supply problem right now. And then when we talk about demand, that's just a big question mark. Demand is always, we talk about it as forward, but it's actually always backward looking. So we don't know demand data for 2024 until about 6 months into 2025. We've really looked at everything. And so every country, every OPEC and IEA, both yesterday, I looked through it and they showed 17 million barrels a day demand roughly for China, which was BS 2 years ago. It's BS now. It's not real. So that means they're still stockpiling, and it creates puts a lot of cold water, I think, into the actual realities of where we're at for supply and demand. And it's partly why trading is as volatile as for oil. This is the OPEC spare capacity that I talked about. This is just a nerdy chart. That dotted line shows you the average spare capacity over time. That green line is actual oil prices, and that bar shows you what the EIA shows for spare capacity out of OPEC. It actually could be a little bit more. A lot of data points show actual spare capacity much more, but let's just say for 2024 was about 4.5 million barrels a day, an easy 2 million barrels a day spare capacity out of Saudi Arabia. And you can see that actually like where oil prices were, like it impacts it, right? The higher your spare capacity is, the lower your oil prices. So it does have an impact. 2024 actually held in there pretty well for oil prices, given how much spare capacity we actually have. And that points to how much geopolitical volatility, the war in Ukraine, the war in Israel. I mean, how much is actually going on? EIA, I do expect this to get better under the Trump administration. And I say this with actually as much apolitical things I can tell you is I'm a data nerd. I'm a PetroNerd, obviously, and I have followed EIA data very closely. It is ridiculous that EIA could be this wrong in their production forecast for the U.S. when they have all the data each month. They know what we are producing. It is not rocket science to look at a productivity curve. Like you and I can get together and we can put some production charts together and we can figure out what production is going to be by the end of this year under a few different scenarios on productivity and oil prices and thinking about rigs and thinking about how many wells we're going to add. EIA should be able to do that too. I think they've been a little bit influenced to probably suppress what oil production was going to look like because the last 2 years they've undershot production. So that's where they forecasted production last year. December 2023, that was their forecast in red. That black is actual. So it didn't make sense that we would actually decline, but that's what they showed. So that doesn't make a lot of sense. And then here's what they're showing now. Barely any growth. Like that's just probably not realistic. Yes, we can't grow as much as we were in the past. We can still grow incrementally. We will get to 14 million barrels a day. We're at 13.5 million barrels per day now. So they have continually undershot. And I think that they need to get a little bit better. I understand why they're conservative, but they're too conservative. Natural gas prices, and I say that too because last year they were wrong on natural gas prices. They were wrong on oil prices. They were wrong on nat gas production. They were wrong on oil production. They just get it wrong every time. And they have the data and they don't have an excuse for being that wrong. So natural gas prices last year were $2. I mean, they were absolutely atrocious. I really emphasize and underscore that because your utility bills were not that low. You saw no decrease in prices on your utility bills. And if you've heard me, I'm very passionate about this. It really does bother me and makes me extremely angry that utility companies are allowed to do what they are doing and not pass through at least some of that savings. I mean, $2 an MCF for an entire year when half of our grid is natural gas is a massive problem. Oh, and by the way, you heat your home and lots of your appliances with natural gas, and yet Excel is just raising those rates up like crazy, but they're saying it's because they're investing in infrastructure. but they're not actually investing in the natural gas infrastructure because they said they're investing in all these renewables, and we got to get rid of the natural gas. So what is it? It is that they're investing in the renewables and they're raising your rates on natural gas to pay for that, and they're kind of hiding the ball, and that is not transparent and it's wrong. So natural gas price today, though, are double that. We have went up $2. I don't think that's bad. I think that the market we do need a little bit higher natural gas prices for the overall market. We have to be a little bit careful if that really starts spiking up, like if we were to get 5 or 6, again, with high oil prices, that's a problem. But if you think about $4 an MCF gas and lower regulations, yeah, you are going to be drilling more. I mean, we saw this in 2022 when we saw high natural gas prices and a massive ramp up in drilling, wildcatting for natural gas wells. So we have to really appreciate the flexibility and the nimbleness of this industry. And when people see high prices, what they do, and trust me, money finds a way. And I really do think when you lower the regulations, when you make it easier to get permits, and you just change the tone. I mean, this is what we started out in 2021 with the Biden administration that banned all permitting on federal lands for 2 full months, for 60 days. That we had a massive decline in federal permit approvals. So everybody says, well, could you increase production overnight? No, you can't increase production overnight. But we know that we're going to get permits approved now. We just know that when you apply for a permit, unless it's ridiculous, like you're probably going to get some permit approvals, there's going to be more permitted streamlining. Gulf of Mexico is a big one. So just having lease sales in the Gulf of Mexico, that's huge. And then permitting those. And once you get the lease, you kind of are expected to get a permit. And that's what happened with the Biden administration is a lot of people paid a lot of money for these leases, and then they couldn't get the permit. And that just doesn't work for business. So I think you're already seeing this, and you're actually seeing it in the rig count that DJ is getting annihilated. Like Colorado is getting absolutely crushed in terms of oil because of the Pulse administration. Wyoming, Utah, the Uinta Basin has more rigs than the DJ. And that's that waxy crude. I mean, that is amazing to see that. But Utah's getting very, very pro-business. And then you start seeing this, like, if you look at Wyoming as well, like clearly people are getting more bullish in Wyoming on the ability to get permits because of this Trump administration. So this is all, I only put these in things because this is, again, the tailwind shifting. You really have to appreciate that. Pulling out the Paris Climate Accords, I already mentioned that. Obviously, I think the Trump administration is going to repeal this ban on future permits of LNG exports. I think they're going to be looking to really get people to really push LNG exports, right? To get the infrastructure built, to try to get the incentive to get more LNG out. And if I'm Department of Energy or in the State Department, under Trump administration, I'm going to be talking to a lot of my allies about how I can assure them that they're going to be able to get this natural gas, and talking more about our natural gas, more about our oil and gas production base, and comforting Japan and comforting other Asian nations that they are going to be able to access our natural gas. And that's something that these nations wanted the U.S. to do under the Biden administration, and the Biden administration wouldn't do it. Also, Ursula von der Leyen with the European Union has already said they're going to buy more natural gas. Literally, like days after Trump was elected, she said, hand up in there, we want more. So all it takes is a bit of a change in politics. So I think you are going to see this. Although Biden did give us a little gift before he left, which was this offshore drilling ban. And it's all this yellow stuff is banned. This is going to be very hard for Trump to repeal. He cannot do this via executive order. But to be fair, we weren't doing a lot. It's not positive for Alaska, but this is Gulf of Mexico is really where it's at. So this is not banned. This is where actually most of the stuff happens. So I would expect, the Gulf of Mexico produces basically 1.7 to over 2 million barrels a day, depending on the season. And there's a lot of excitement around that. So we could increase production pretty quickly with that. The Pentagon has added a bunch of companies to their military lists. I only say this because this is one of the many, many things going on with China. So this is positive. There are a lot of things I don't like about the Biden administration. Some of the stuff on China has not been horrible. This with Pentagon adding these companies to them, like as Chinese companies that are affiliated with the Chinese military. Newsflash, every single company in China is affiliated with the Chinese government, is affiliated with the military. If China wants to get affiliated, all they do is call them, they just make that happen, or they put them out of business. So every company is. That's why you really shouldn't be doing business in China. But cattle, and like Costco Shipping, huge shipping company, they are now affiliated. And so it doesn't mean that basically they're not sanctioned, but it means that it might be hard for publicly traded companies to actually do business with them. There might be SEC rules and issues, and it just kind of looks bad if you're a publicly traded company in the US and you are doing business with a company. Cattle, CATL, that's a battery company. Ford is doing business with them. That's where almost their batteries are coming from. Tesla is doing business with them. That doesn't look good. And these are really serious. It's not about looking. It's that these companies are affiliated with the Chinese military. They're building up their manufacturing and industrial base, and they're not doing that for kicks and giggles. They're not making money on it. They're doing it to build it up, and they're just dumping all this stuff on the market. So just keep that in your head. That's a U.S. Strategic Petroleum Reserve. This is, again, one of those, as I mentioned, the levers. It is coming up a little bit. But this is something when you think about the leverage of, you have to watch this closely because you want to do it when prices are cheap, which the Biden administration did not do. So if prices get too low, I would expect Trump and team to try to refill this. They're going to want to incrementally fill this over time anyways, but it does help. It's something that if we get too low of oil prices in the U.S. because we're producing more, because Saudi Arabia gets unleashed or whatever, we have some leverage here, and that's actually probably something that they could talk to Saudi Arabia about as well, of saying, hey, look, we can put a floor on oil prices because we can refill our SPR, which means we're not going to let prices go to 55. We already talked about the headwinds and tailwinds shifting. There's no on the White House. They're gone. I think we need to talk a little bit about getting real on the energy transition. I am not hearing this overtly covered. Like, you hear a little bit of coverage about Trump administration is not going to be he's not going to be super friendly to renewables, or he's not pro climate change, and all the policies and initiatives. You're hearing this with regards to the fires in California. Chris was asked about them yesterday, about the fires in California, not kindly at all. But this is really serious because I just think this is not going to be the policy focus of this administration. It's not going to be fear-mongering about climate change. And the rest of the world does need to appreciate that, because this means that, you're already seeing banks pull out of about a lot of climate change, like funds, a lot of climate change policies. That's a really serious move. And so I think that the fact that the rest of the world, IMF, is still talking about this in the degree that they're talking about it and telling us that we're all going to burn up in a couple of years, one, that's just not true. And two, if it is, your batteries aren't going to save you, your wind's not going to save you, your solar's not going to save you in extreme temperatures in just a handful of years. So there just needs to be a reality check on this. And I think for certainly in the US, the investment cycle, this is not going to pan out the way people in the past few years were thinking. And I think this is what you really need to watch, is the potential. These are oil and natural gas prices where we're at right now, right? We've had natural gas prices low, they're creeping up. Here's oil. Oil prices, your actual investment and what these companies are worth from their productivity potential, what they mean in a long-term trajectory, have not traded that way. And so you've had this, utilities obviously have been through the roof because of all the policies and everything, and utility companies just being able to pass rate increases. But I think that's the stuff that you need to watch. I'm not going to say that oil and gas companies are going to boom and the prices are going to go up, but I do think it's more investable to do business. And that's where some of those headwinds and tailwinds have shifted. Now, we do have a lot of production resiliency regardless of price. So that is the U.S. production, that 13.5 million barrels per day. And yes, these higher oil prices have certainly helped that ramp up. But if you pull out all the data and you look at individual basins, you'll see the Delaware Basin has there's one trajectory for the Delaware Basin, one trajectory for New Mexico production. It is just up. It doesn't matter where prices were, it was up. That's how it was. So U.S. production is very resilient regardless of prices. So I actually think that even if we were to drop to 60, if people get their bearings and understand we're at 60, I don't think you see material drop. You're not going to see a drop in oil production. You might see, a little bit of pullback from privates, and private companies are more sensitive. But private companies are the companies now that are going to be off to the races with this administration. When you lower regulations and you make it easier to do business, you allow these smaller private companies much more flexibility. They did not have the bandwidth or the staying power to fight the past 4 years of this Biden administration with all the money and the legal bills, and they can't go to Washington every week like Exxon. So this is I think it's really, really important to appreciate the role of private companies and lower regulation and just what this trajectory can be under a slightly lower oil price environment. Natural gas, we had come down a smidgen, and then we're just back. We've moved back up. So we were at 128 BCF a day. Prices corrected. We're storing natural gas like crazy in 2024. We didn't have the cold winter in 2024. We are seeing that cold snap now. That's partly why you're seeing oil prices up as well, is because we have diesel demand for heating oil on the East Coast. You're seeing gas demand. So everybody's needing power and fuel and heating their homes. And so that's partly why we're seeing the rise in nat gas prices and oil as well. The other thing to just think about is this, Trump campaigned on drill, baby, drill, and frack, frack, frack. People joke about that. He is serious about that, right? He's serious about just letting people go and unleashing. I'm not certain, but I do think the frack, frack, frack thing might have been for Chris a little bit. And I kind of like that. What politician actually knows what fracking is? No one. There's not a single politician that actually knows what fracking is. Trump actually did, so that's cool. This, though, that's just what you have to think about, is in terms of prices of, $80 oil, that's enough to incentivize companies to go to business. $60 oil is still enough to incentivize companies to go to business. So, we had lower prices under Trump before, but you have to realize that $60 oil, that's a good price environment. Our companies have better margin performance, are doing better now and making more money than they were in prior years. Even with lower oil prices, companies or even with higher oil prices, companies are doing better now. And so there's a lot of goodie left in terms of maximizing oil output, just improving your production base, working on existing wells. That is something that Trump could also focus on too, and actually emphasizing the production base, and then also just not demonizing the industry and allowing investment to flow in. I think the market and a lot of analysis has not appreciated all this, but I think it's really important to appreciate NGL prices and natural gas prices. So yes, natural gas prices could go way back down, but NGL prices have held up. NGL prices are more correlated to oil prices, and so that is why you still have a lot of natural gas production. You have a lot because you have so much associated gas production coming out of the Permian and all these basins, but you also actually have a lot of natural gas production from the liquids-rich plays, from the liquids-rich areas in the Haynesville, and from the Marcellus. And so we're not going to get rid of the natural gas production. We have that's staying here, and it's going to go one direction. But it's very important to pay attention to NGL prices because that's also really missed, I think, in the analysis as well. And something, if oil prices go down, but NGL prices stay with oil, and you have slightly higher natural gas prices, all of that works to continue growth in oil and growth in gas. So whiplash, I've probably given it to you already, just with this back and forth on oil and everything. But you certainly have it. If you just literally type in oil in Wall Street Journal, Financial Times, holy moly, this is what you get. It's oil edges higher, oil eases, oil jumps, Iran races to sell, push oil prices goes down, oil slips. I mean, those are literally daily and can be hourly of oil prices are up, oil prices are down. So coverage of oil is atrocious. And what we saw last year was that coming into this year, a lot of shorts, right? A lot of people, a lot of negativity on oil because you had Saudi Arabia essentially saying, hey, they didn't say we were going to flood the market. They actually extended OPEC cuts, but they basically wanted to put OPEC players in check and say, hey, we won't hold the bag forever and you need to not be overproducing. That didn't really work. They actually extended their cuts and they're holding the bag. And then you saw the Wall Street Journal come out with this article that said, oh, we're going to have even more restraint by major oil companies. I don't really buy that because the more restraint doesn't necessarily mean I'm actually producing less oil. And we don't see that in the data. We see lower rigs, we see longer laterals, and we see more oil production. And then you see the whole thing on China. China hits a headline, and you have a lot of algorithmic trading in oil, but China demand is crap. China is stockpiling a lot of crude oil, and there's a lot of messiness in terms of when they stockpile, where it goes. The fact that Iran has that big of a stockpile in China, was that in the data? Did we use that as 17 million barrels a day demand? Was that completely hidden? Either way, it's not truthful if it's in their demand, and it's not truthful if it was hidden. So it means that we're not fully capturing all these barrels. And JP Morgan has put out some work that actually shows that really well, is that we are not fully getting a full picture because of China and their stockpiles of what oil supply and demand actually is, or oil demand is. This is what the EIA, kind of in line with everybody else on forecasting demand, just a modest uptick. I mean, look at the jagged lines, you're really not going to be too wrong there. I think we have to be careful. If it's actually going to grow that much? I don't know if it's going to flatline. I am not as bullish about this ripping demand growth. Yes, can we incrementally grow? Absolutely. Can we decline? 100%. As I mentioned, OPEC extended these cuts. They're going to probably keep extending these cuts, but now all this is in big question mark. They did this at the end of last year, but this is a big question mark in terms of the Trump administration of, again, silence from Saudi Arabia. So when Trump gets in, and depending on where the ceasefire is, what we're doing with Israel, or what Israel is doing, there's going to be a lot of talk. There's going to be a lot of folks going to Saudi Arabia to say, will you bring these barrels back if we sanction Iran, if we can't get a deal with Russia, and if we sanction this crude, if all these things get implemented, this thing is going to be thrown into question. Okay. Switching gears to the U.S. economy, and you guys are just going to have to, I'm clearly going to go over a smidgen. Let me know if you're okay with that. If not, we can just cut it and we can do Q&A. U.S. has a massive amount of debt, so household debt. We have about $18 trillion in household debt. This keeps rising incrementally. I think it's really important, this is 2008, so maybe I'll walk over here and you can see this a little better too. This is 2008, so we had this uptick in U.S. household debt. Everybody bought homes, everybody went bananas. This is where we're at today. This is a massive growth. So this is kind of steady. This is normal. And then when COVID happened, we had 0% interest rates and everybody bought a home and everybody went nuts and did all the spending. A lot of that, people always say, okay, well, those homes are financed at 3%. that's fine, that works, but if you bought $1 million home and you financed it at 3% and one of you in your household loses a job, you still have a very large payment to make. And so what we've had in this economy is pretty well full employment. Nobody's really lost a job. So all this is sort of working right now. If people lose their jobs, this doesn't work anymore. And what's really at risk is this last chunk here, because this is all at 7%, it's 6% or whatever. And this gets risky and starts getting messy. And it doesn't look like a lot, but a couple $1 trillion can do some damage. You know that a couple $1 trillion can do some damage because we hear about, several $1 billion losses and how the stock market can go down when Nvidia moves a few $1 billion. And then you have all this other debt, which is going up. And so what you're starting to see is that people say, okay, we're okay. And we do have a lot of money in the system. So regardless of all this debt, there's still a lot of money in the system. But I think it matters because if something breaks, this is when you have contagion and this is when you can have a black swan, a financial crisis or crises. So that's your mortgage debt. That is a pretty massive rip. Again, this is what I'm worried about is this bit here. This all is risky, but this bit's the most at risk. And then this is all your other debt. Credit cards, student loans. You notice that auto loans have gone way up. You've noticed that this is your revolving home equity. That's fine. But your student loans and your credit card are going up significantly. And Biden actually took off your student loan in terms of like impacting your credit score. But the moment last year people had to start repaying their debt, and then the debt started going up. And then you're starting to see credit card delinquency actually go up. So this is your credit card delinquency by like severely derogatory, like severely late. Is that red? That red is what's severely going up, and that's the severely late. And then your 90-day delinquency. So I'm delinquent by that's 3 months. You're starting to see that also go up on credit card massively. This is not a good sign because people always say, as when we hear about like savings going down and people have less money since COVID, the coverage in the market is always like, oh, it's fine because everybody's paying their credit card debt and everybody has savings. Well, when you've had inflation the way we've had inflation, you need a lot more savings than you did prior to COVID. So we have to keep that in mind as well, so if we're having delinquencies like this just is not a good signal. So when I mentioned in the beginning that I think data is starting to roll over, these are the things I'm starting to see that don't look positive to me. And again, I'm bullish on policies of the Trump administration, but he can't stave off a global recession. He can make it better in the US, but like these are problematic. That's your average housing price. Again, this is why I'm not happy with the Fed. They did nothing on this. So our average housing price is still $500,000. This is ridiculous, this massive jump up. This makes housing unaffordable for almost everyone. At 7%, like no one's buying a house unless you're a millionaire and you're paying a couple million on a cash offer, which is actually what a lot of people are doing. So a lot of homes that are transacting are actually cash offers. At your average mortgage size, which hasn't moved a lot, it's still about $400,000. And so people always say, 1970s and interest rates and everything, houses were a lot cheaper. Like your amount that you were mortgaging was just so much less then. So there was a lot less risk in the system. So I am concerned that if I have a good chunk of mortgages at 7%, a couple $1 trillion of them, that makes me concerned. Or could be concerning. U.S. oil demand, so this is, we call it product supplied, but it's demand. Just important to kind of nerd out with this chart for perspective is that this is, we're looking at 1986, so that's when I was born. This is oil demand, steadily grows. This is pre-2008, right? We're just ramping up, we're raring, like it's 2000s, everything's awesome. People are buying homes like crazy. And then it starts clipping, right? We start going down, oil prices peak, so I'm giving you some clues here, not saying this is going to happen, but oil prices really ratchet up, right? We have this massive, $140 a barrel. This is the demand loss of U.S. oil demand. We led the world in demand loss. So we lost about a few million barrels a day globally, but we lost a couple million barrels a day demand in the U.S. And then it took years for that to come back. And then pre-COVID, we're kind of back to where we were in 2008. We're like ripping, raring, and then we drop, and we have not quite come back. We're like coming back, but we have not quite come back to our pre-COVID levels of gasoline demand. And I get asked a lot by CEOs and executives, like, well, isn't some of this EVs? No, I don't think so. I say that for a lot of different reasons, but that's because if you have an EV, you cannot sell it right now. Like nobody wants an EV. You cannot sell it because no one wants to buy one. So no, I don't think the demand, like there might be a smidgen of that in gasoline demand, but that red line is your gasoline demand. I think the red line correlates far more to this ramp up we had in oil prices post-COVID when people started driving, and then we got these high oil prices and it muted gasoline demand growth. We do see this where you look at like jet fuel, there's a nice correlation. Lower oil prices or like steady oil prices and jet fuel demand correlate. This is your gasoline demand in black, and that is your like vehicle miles traveled. There's a couple different ways to look at that. You can see that vehicle miles traveled are basically coming back to where they were, not quite, but our average gasoline demand This is 2019 to 2020 was 9.3 million barrels a day, and now 2021 to October 2024, 8.9. So we're 500,000 barrels a day off of gasoline demand. That is not nothing. That's a lot. Work from home habits, people driving differently, a lot of different things there. But jet fuel demand, that's jet fuel demand, and oil prices. If oil prices creep higher, I think jet fuel demand gets curbed, and I think it could roll over, and that's global economy stuff. Yes, rich people fly, we all will fly for work and everything, but if prices get over their skis, it'll be a problem. This is your air passenger miles. I only show this because I was looking at all these data points. Again, is this ripping higher? Well, it looks like 1 data point, 2 data points, 6 months. I'm going to watch this for months and see. But this could be rolling over. And it's this rolling over that I'm a little bit nervous about because I'm seeing it in every data point. It's starting to see that rollover. Diesel demand is far more concerning to me. That is 100% not. We're not seeing EVs eat out diesel demand. Diesel demand is your economy. Diesel demand is construction, it's housing, it is trucking, it's rail, it's everything. And diesel demand, it's not down, but it's soft. And it is a little bit concerning to me because you can just see where it was pre-COVID. Prices are up. Obviously, it correlates with prices a bit. And this is where I think people are not appreciating price sensitivity to gasoline and diesel. You can see clearly in the data. Prices are high and demand gets soft. And that is way more. You see that way more in global data outside of the U.S. than you see in the U.S. And if we're the only bright spot, it's just something you have to really pay attention to because we are 20% of global demand. This is U.S. truck tonnage. It's not strong. It's not tanking, but it's not amazing. That's also diesel demand. Our interest payments on our debt, so our fiscal deficit, the thing I talked about in the beginning, yields rising. Part of the yields rising is because our interest payments on our debt are $1.4 trillion. That was just Q3 of 2024, $1.4 trillion. That is way more than our military spending. That is a massive chunk of our federal budget now is going to just paying interest payments. So this is a really, really big problem. And this is why partly yields are higher is because we just have so much debt. The jobs data came in slightly better than expected. That's why the yields went higher because they're thinking that, the Fed was going to lower interest rates. But it was interesting because that's also what drove yields. Part of driving the yields higher was that jobs data was good. So then people get concerned that the Fed is not going to lower interest rates further. And so average hourly earnings, people say, oh, it's not so bad. Well, it's still pretty elevated we're still 4%. So you're still paying people more, which helps a little bit to offset inflation, but it also puts a lot of pressure on, obviously, businesses. And this is where unemployment is. It's creeping up, but it's hanging in there. It's at 4.1%. People call this full employment. I think that there's a lot of economic weakness under the hood in jobs. People are not moving jobs nearly as much. You are hearing about more layoffs, and you're just not seeing people quit and go to a new job and get money. If you are making a couple $100,000 a year, I think it's going to be very difficult to replace that. I would not be quitting any jobs if you're making 6 figures because where are those other jobs? Where are you going to go to actually get that? And that's where I say the oil industry is so important. The fact that we're producing 13.5 million barrels a day, we're keeping so much of that money at home. But in the oil industry, you can make a couple $100,000 without a college degree. And that is one of the few industries in the world, but particularly in the U.S. where you have that. And so there's a lot of economic wealth creation in the U.S. from this, and it means it makes it really important. So it's very healthy for the economy in the U.S. to have slightly lower oil prices, but it's also, there's a lot of benefits to the U.S. because we keep so much of this wealth at home from slightly higher oil prices as well. This is housing starts, and you guys are going to have to tell me where you want me to stop here, but I'm going to go through this and then we can switch gears and go to close with U.S. shale if you want. So housing starts, the only reason I show this, and I break this out for different clients so you can see it a little bit differently, but this is total housing. That's your single family homes, and these are apartments. And so again, if I'm looking at data and I plot oil prices with it, it moves in lockstep, or it has been kind of moving in lockstep as of late. Housing starts actually started tanking way before the financial crisis. So people just weren't paying attention. They came off a cliff. Now, we kind of saw this, them coming down, in 21, 22. That's because interest rates were rising. But now they've kind of moved in lockstep with oil prices, just because that tells you a lot about the economy and the inputs and everything. But it also, you see that we have all these apartments. And the one thing I will say is that everybody says we don't have enough homes. We just don't have enough homes. There's no way housing can go down because we don't have enough homes. Everyone does not have to own a home. And in fact, it's more expensive now to own a home than it is to rent because of the costs in Colorado for our property taxes have gone up massively. All of our bills went up significantly last year. Your utility bills are much higher. So the cost to actually rent is cheaper. And so we've built a crap ton of apartments, Look at that. That's where we were pre-2008, and that's where we were for apartments. So housing, we have to include apartments. And I don't think the market's doing a good job of that. So I actually think we have plenty of housing. Now, everybody has to buy. Historically speaking, you do not have to own a home. That changes over time. So just watch that closely. That's your 2-year and 10-year. Something I'll note too is the 2-year yield and a 10-year treasury yield. People talk about like inversion and how we were inverted on the 2-year and 10-year. You actually, when you go into recession is when you disinvert. So right before your recession, you actually disinvert. Again, not saying we're going to recession, but I think this year it's interesting that no one's talking about it. And this is probably the year you're probably closer to it than you've ever been, but we are kind of disinverting. And I just think that there's things that could stave it off. It's actually hard to stave off a recession since 2008 to now. Like it's kind of, there's an inevitability of it at some point. We have a lot of money sloshing around, but those are things to pay attention to as well. That's your 10-year yield in WTI. That's fun and nerdy to watch and look at because they like move in lockstep, but when they break out, again, when you start seeing big moves, things can happen. But right now we're seeing the 10-year yield rip, and we're seeing oil prices rip too, but they're kind of a little janky. Single biggest takeaway and something I just really have to nail home is that this is the federal funds interest rate. So oil prices in green, unemployment in purple, creeping up a little here, and that's your inflation in orange. So inflation comes down and then kind of gets sticky, and then federal funds rate goes up, flatlines, and then comes down. Direct correlation, as the Federal Reserve lowers interest rates, inflation actually goes up. I don't know, it's because they didn't do a good enough job and they probably should have raised interest rates a little further, but that's painful to the economy, but it also is what curbs inflation. Historically, you can see this, and I don't like looking at this because it's depressing, but see these flat lines? When the Fed flatlines interest rates, then unemployment comes up. Happened here, really happened here in 2008, and we had this little flattening here, and now we flatlined here. So not saying that's what's gonna happen, but the trajectory doesn't look amazing. Inflation, so this is what came out yesterday, and I was really not happy about this because the market was like, hey, this is awesome. Electricity is still 3.1%. Not sure how they calculate that because electricity has been flat at 18 cents a kilowatt hour for the past 3 months. Yet in their charts, they actually show it declining a little, but it's been the same price. Services are still over 4%. Shelter is almost still at 4.6%. Is still really, really high. We actually saw an uptick in food inflation. Food at home is 1.8%. Food is 2.5%. Food away from home is still 3.6%. So if you tried to buy eggs lately, they're about $1 an egg. So that's pretty painful and exhausting. So that's just really, really serious. That's beef inflation is huge, and electricity prices. So mentioned Germany. And then I'm going to stop in just a minute and you can tell me where you guys want to go. I'll get your feedback. This is just your electricity prices and that grid in Germany I was talking about, the what not to do. This is the renewables in Germany. That's power generation. That's coal declining. There's a direct correlation with this you see in every grid. When you decline your baseload power generation, whether that's nuclear, whether that's coal, that's your dispatchable baseload. So when you decline that and then you add these expensive renewables, your electricity costs go up. It is not rocket science. It happens every single time. So it's absolutely happening in Colorado. But Germany, they're cutting thousands of jobs. They're closing Volkswagen plants. This has never happened in history. Volkswagen has never shuttered plants. They've never done massive layoffs, and they're doing layoffs across the board and pay cuts. German manufacturing, we went through this, atrocious. Car production is down. They're very correlated to the Chinese market. So they're exposed to China because they let the Chinese come in and compete with them and just dump stuff in their market. And you can see Chinese passenger exports, they're just dumping these cars on the market, are massive. You can also see that Chinese residential home prices, and again, this data is massaged, but it's still the data, have just tanked. The Chinese property sector is 30% of their economy, or roughly 30% of the economy. So they just have no growth. You really see that in cement output. So no matter what anyone tells you of how healthy the Chinese economy is, just look at something like that. Your cement output is down. That means your economy is not doing great. Your steel production is coming down a smidgen as well. Again, all that's massaged, so it's probably a lot worse. They're massively exporting electric cars and passenger cars on the market, dumping them. And big takeaway chart along with that inflation chart is this, is that if I have a Chinese economy that is even slowing or flatlining, I should see something in the energy across the board, whether it's electricity, whether it's energy demand, anything, where it slows with it. But that's not what happened. In COVID, when they shut down Shanghai for 2 months, when they shut down cities like crazy, when they had very low economic growth because they literally shut down cities, their oil demand still went through the roof. So something's off here, right? It means that they're stockpiling, but it's really important to pay attention to just even the crappy GDP growth and oil demand. That's not how it works in any other economy where you have something declining but you have growth. And in energy, everything's growing, which tells you they're doing something else. So I'm going to stop here and say, do you want me to go through a little bit through geopolitics and eat into your Q&A time, or do you want me to stop and do Q&A? Somebody give me some. Okay. All right. All right. So this is the war in Ukraine. We are now 3 years in. Trump does want a deal. Like he's been talking about this. He wants to cut a deal. Ukraine's putting a lot of chips on the table. Russia's putting a lot of chips on the table. Fighting has intensified. So it's not clear that they are definitely going to get a deal, because it's not clear that Russia actually wants a deal, because they may want to continue this war. So there is a question mark in that. Could it happen? Absolutely. But could it not happen and they have to sanction Russia and we have to do more? Absolutely. And that's something that people have to think about. This is how the war started. That's like day one, what the map looked like and what Russia had done in Ukraine. Then we have North Korean troops get deployed in October of last year. So that was an escalation. They're getting decimated, but still, like, they're just throwing people at this, and Russia's going after infrastructure. They're going after energy. They're going after all this stuff. And then late last year, as morale was really, really down in Ukraine, Zelensky has this bright idea to say, we're going to boost morale domestically by taking our troops and putting them in Russia and creating this new offensive campaign. And he really needed it because he needed to boost morale just for the war itself in Ukraine. And that's important to point out because they are struggling to get Ukrainians on board with this war. Something that Trump has just asked for was them to lower the enlistment age. I was shocked that it was 25. I mean, it's much lower in other countries. And basically the incoming Trump administration was saying, you have to show us that you want to fight for this. And they say, hey, we do want to fight for this, but we need more weapons. Well, if your conscription age is like, if the average person on the front lines is 40 years old, you can see where they're getting war fatigue. You can see where people are not invested in this. So that is a problem where they're starting to have domestic war fatigue, where people don't want to fight, they don't have power generation, they just want this to end. And that does, unfortunately, that does give Russia some leverage, and that means that they want a ceasefire. And I do think you're starting to see that they do want a ceasefire. But now this is what the map looks like. This is the chunk. This is going to get, if we have a ceasefire, we get a deal, Russia's getting this. They're just going to get that chunk. Now, whether or not Russia's going to be happy with that is a bigger question. But this is the fact that this is going on Europe's doorsteps, and Europe has just declined and continued to emphasize energy transition. They're just outside of their minds. Geopolitics is real, war is real. This is very, very real. And it's just not been, it's in the background. They care way more about trying to get wind into their grid than they care about solving this massive crisis, or at least it seems that way. The Houthis are continuing to attack ships in the Red Sea. This is inflationary. This is something that if Trump, if the administration pushes back on Iran and ends some of this will be helpful. So if you sanction Iran and you take away the money that they're getting for the oil that's going to China, you're going to take a lot of money away from them. And that's why they were trying to sell these barrels out of China, because they know they're not going to have money, right? They need all this money to pay the Houthis, to pay Hamas, to pay Hezbollah, to do all this damage. And so if we stranglehold Iran and they can't attack all these ships in the Red Sea, almost every ship, American ships and European ships, anybody who's touching or supportive of Israel can no longer go through the Red Sea because they're going to get attacked. So Russian ships, if you're a bad actor, if you're China, you can definitely go through the Red Sea. They actually advertise that they're Chinese vessels, and they say, we're China, and they get it going right through. And that means that all the other ships have to go around the Horn of Africa, have to go around, literally doubling their time to move around the world, which means they have to increase their fuel costs, increase their shipping costs. That drives up inflation, that drives up fuel costs. So something like this, there are a lot of things that they could be done that could help on the inflation side and be deflationary. Russian trade with China, this is just as of 2023. It's in lockstep. So China is funding this war in Ukraine, 100%. No, there's no doubts about it, right? All the massive trade. China's buying crude, they're buying grain, they're buying coal, they're stockpiling everything, getting all this stuff very cheap from Russia. And Russia in turn is getting a lot of technology, everything they can't get from the rest of the world. They're getting chips, they're getting weapons, they're getting technology. So I say this because I think people just look at these numbers and they think, hey, it's no big deal. This makes sense. This actually means that China's kind of on a war footing, right? They are making military equipment and they're giving it to Russia. So that's helping their economy to stay afloat, kind of. But it also means that they're making military stuff and they're giving it to Russia. They are. It helps them thinking thinking about war preparation and just what they're doing. But it is kind of a war footing, whether they're fighting the war or not. If you're making the equipment, you're part of it. So this is just production. I think really important to appreciate. It was a little tricky to find this on EAA, but I found it, and I downloaded it. So this is Russian production, Saudi production, and our production. And the reason I say this is so important is because when people talk about energy dominance, it's a real thing. Like, this Biden administration could have leaned into energy coercion, energy dominance, the fact that we're producing so much oil. We really are. Like, the world has changed when Russia's down here and Saudi Arabia's down here and we are producing, we're up here. So we've opened this gap, and now we're producing more than Russia, more than Saudi Arabia, but we're also exporting more crude oil. So we're the largest exporter of crude and product in the entire world. So we do have energy dominance. And so that creates a lot of leverage, a lot of geopolitical leverage. But it's important to point out that, like, really, they've been pretty steady. It's really impressive to see how well Russian production has done with this war in Ukraine. The fact that they have this war, they've clearly committed to maintaining output, and the fact that sanctions have done absolutely almost nothing. Like, we have just not dented, Russian production or the Russian economy to a massive degree, right? Biden doing this at the end, he should have done this at the very beginning. Like, yes, it's raising oil prices. You should have done this at the very beginning. Like, it is just really sad that you do it at the very end and leave the next administration with high oil prices. Like, that's a repercussion. I'm fine with the higher oil prices, but I'm not okay doing it at the very end when you could have done it at the beginning and you actually maybe could have made a dent here. Or the fact that you even have any sanctions to lever, you shouldn't have any left because it should have been done in the first place. But you can see how stable, basically, actually Russian, it's jagged, but it's there. And then even Saudi output. Yes, it's come down, but Saudi output's pretty stable. Like, they just hang in here. This is really meaningful because you have to think about, like, Saudi Arabia, how are they thinking about U.S. production, right? Like, how are they really thinking about this? Like, I was not invited back to the Oxford Institute for Energy Studies. I've literally spoken there for like 15 years. Every year I go and talk on U.S. shale. Every year it's like, that's all anybody wants to talk about. And we get into the weeds on U.S. shale and how it works. There's a lot of foreign individuals in the room. And it's literally the most topical issue. And at 13.5 million barrels a day, it's shocking to me that on oil day at Oxford, they didn't bring me to talk about U.S. shale. And it sounds to me like the rest of the world doesn't want to hear that the U.S. is producing 13.5 million barrels a day. And it's getting uncomfortable for people. So this is just a reality that, got to back up, that people have to deal with this, is that we are producing all this oil, and I don't think from a geopolitical perspective we're appreciating like how the rest of the world is thinking about it. So put a pin in that. That's one to think about. Russian crude discounts, we really haven't seen, that's their export revenue. Yeah, it came down, but it's flatlined. Their discount has not been massive from Brent, as you can see. So they just really haven't been hammered to the extent that people thought. This is Iranian crude oil exports and Chinese imports. So it's actually more than this. It's probably about 2 million barrels a day, but you can just see this massive ramp up from January 2022. We had the ability to not let this happen, but that's a lot of money. That's on the back of the envelope, $80 oil. It's over $4 billion a month that they're getting. So this will be sanctioned. And so these are the things that you have to think about in terms of moving crude around. That's Chinese oil demand. You've seen that before, but that means that crude oil is going to have to move around. This is another way to look at that exports. This is Russian exports in yellow, Saudi exports, and that's U.S. exports. So we are the powerhouse of oil and gas production and exports. And then if you think about OPEC production, that's they've edged up a smidgen. They're at 26.7 million barrels a day for OPEC production. I mean, if you went to an OPEC report 10 years ago, they told you they'd be at 40 million barrels a day by now. 40 million barrels a day would be their market share. I mean, they're nowhere near that because we are just eating into that. So this is a long-term issue that's going to be here for a while. And this is something that I'm not saying, it's tricky with the Saudis, but like this administration, the way they talk to them, how they're going to deal with this, how the Saudis see this, but it's almost like everyone's ignoring the fact that we're producing as much as we are, and they probably are having consultants go over there and telling them that we're going to roll over, our production is going to roll over, and it's not going to be a long-term threat. And I highly disagree with that. I think that they need to appreciate that, and they probably do internally, that U.S. shale is going to be around here for a while, but we're eating their lunch, no question about it. And you can just see that that's our imports, that's our exports. We are now clearly a clear exporter. And again, now we can actually do more because we have policies, and if we have policies and infrastructure in place to do it, cannot underscore and underline infrastructure enough. We have to build the LNG infrastructure, we have to build the pipelines, we have to build the capacity to actually export this. But that's our exports, that's crude, that's NGLs, and that's product on top. So we're exporting over 10.5 million barrels per day, a massive amount of propane, a massive amount of gasoline, and diesel as well. Propane, I went to the PBR last night, and you see the fire that shoots up, but like, it is my favorite NGL, but I think the fact that we could export more propane, we are exporting a lot of ethane, like that just gives the the world needs it, and it's an incredible fuel to actually heat homes and cook and everything, but the world needs it, but we have a lot of production. So if we just think about doing a little bit better on our infrastructure and a little bit better at exports, there's a lot of room to grow in terms of our ability to increase output. This is LNG exports. I'm going to run through this really fast. They've been in the doldrums because we have not seen prices rise because of prices last year. We're going to see this go up. Coal prices, this is coal prices, right? So coal prices are basically flat. And we do really need to appreciate this, is that coal prices are flat. LNG or natural gas was $2 last year, so it was competitive. But if we're declining our baseload coal-fired power, what's happening is that our grid is becoming unstable because we have so much natural gas. So if you have a bunch of natural gas and then you take out your coal, you can't use that cheap coal when you have spikes in natural gas prices. So I want more natural gas on the grid, absolutely. But I also don't want to decommission my coal because I want to use that coal when natural gas prices get too expensive, and I want to be able to pass those savings and those efficiencies onto the consumer. And so if you just look historically speaking, coal prices are exceptionally low. We have more coal in the US than the entire world from a reserve perspective. We're producing a lot less. We're still exporting some to China and other countries, but China is 100% coal driven. 100% of their economy is coal. It's like 70% of the grid, but basically 100% of the economy is based on coal because it's really cheap. So this is US electricity prices. We're that 18 cents, we've been there for about 3 months, but that's the trajectory. This is what's happened under, we've had flat electricity prices, and then for the past 4 years, just massive ramp up, which is a lot less than Europe, but it's still really, really high, and we didn't have inflation in electricity prices. And this is just electricity prices and our grid. So I put wind and solar together, so I put those in green for you. Your blue is water, it's hydroelectric, your gray is nuclear, and your natural gas is yellow, and your coal is black. So that is what our grid looks like. That's power generation in the US and prices. So what you see is that as this changes, right, we start seeing this increase. And you can start looking at, is that because we added wind and solar? Or is it because what did we do? And if you take away the stacking and you just look at what it looks like, we declined coal, we've added natural gas, so we've added this wind and solar massively. And so when you kind of coal, again, that's your base load. So it's not just that we've added wind and solar, and that's definitely a part of it, right? As we've added wind and solar, our electricity prices have massively increased, but it's also coal. As we've declined this baseload power, this cheap baseload dispatchable power, we've also had a massive uptick. So I am not anti-coal. I think natural gas is better, it's cleaner, it's more efficient, it's a higher fuel density, but I am absolutely not anti-coal because I understand the importance of it in our grid. And I'm really sad that Colorado has just lost their way on energy, completely lost it. I mean, Polis might be one of the worst governors of energy, in history. It's California's close, but he's second for sure. So this is electricity prices globally. There's a direct correlation when you add wind and solar into your grid. That's just from the Colorado Sun, talking about Excel's rate increases. You just saw a natural gas price increase in November from Excel, saying that it's for natural gas. Obviously, it's paying for renewables. But this is what's highway robberies, this $23 an MMBTU, that average residential natural gas price when natural gas prices were $2. That's a massive disconnect, just huge, and completely wrong. So utility companies were just raking it in hand over fist. This is a paper I did with Common Sense Institute. As of 2023, coal made up a third of the Colorado's grid. So a third of the power generation right now in these lights are coming from coal. All of the coal is slated to be decommissioned starting this year through 2031. So a third of our power generation is just going to go out the window. So not only will we not have power because there's no plan for the backup, your forecast electricity prices are just going to go through the roof. So you will no longer have a reliable grid and you have high prices. And you can see this in the data. You can look at our CO2 emissions and our actual rise in our natural gas. If coal comes down, natural gas comes up, there's a direct correlation with our CO2 emissions. And China has a third of the world's power generation. That's total power generation. I am going to stop right here. I know we didn't get into U.S. shale, which I have a lot of data on, but there's a lot to cover, and I hope that was what we wanted to cover. If you want me to get into U.S. shale, I absolutely will. But I'm going to stop right there and open it up for questions. Yep.
What's an affordable thing that America can do to put more pressure on Russia?
There's a lot of affordable things. So you have to, I guess, enforcing some of the existing sanctions, maybe changing that price cap on crude. I mean, all we did for the large sanctions were just put that price cap. But probably the most affordable thing would be to they're not getting much leverage from gas anymore. So you could say we could increase natural gas exports. That's very affordable. That's definitely something we could do to influence it. But it's really probably actually increasing crude oil exports, right? If the more oil we get onto the water, the more we're increasing global energy security. So those are simple things that we're already doing. But in terms of like the affordable things we're going to have to do for Russia to like rein them in, is if you could get a ceasefire, right, is to start normalizing relations, right, and see like what you can do that. I know that's really hard for people to appreciate, like to people even talk about. I'm not saying that Russia's not horrible, they're bad, they've done awful things, but in terms of like the grand vision here, in terms of China's much worse, like do you really want Russia and China in bed together forever? No, you don't. You actually want to break them apart, because that's an axis that you really don't want. So there are things that we just need to do, and like energy strength, and just strength and peace through strength is one of those. So in terms of like sanctions, all those are going to be expensive. But those are simplistic things I would say: increase your crude oil exports and increase your nat gas exports. Crude oil having a bigger difference than nat gas. Yep.
So I'm just wondering if you, what you think if there will be an uptick in oil and gas production in exports to Europe with the incoming Trump presidency. Him saying drill baby drill. So what do you think the U.S.'s capability of ramping up the export production capacity to Europe is? Like, can we compensate for that? Can we compensate for the infrastructure that we will have to build?
In terms of sending Europe more natural gas?
Correct.
Absolutely. So it's not, we have a lot of natural gas, LNG, volume coming into the pipeline. So we're right now nameplate capacity, I'm guessing probably 16 BCF a day. If we needed to export 16 billion cubic feet per day, we could probably do it right now. We're exporting between like 12 and 14 BCF a day, according to given the market, probably obviously higher a little bit right now because of a colder snap in the weather. So that means quickly we could do it right now. We could be pushing 16 BCF a day out there. And then it's really building out more infrastructure, right? Getting a streamlined infrastructure permitting process, getting stuff built, getting the investment, getting it all put together. And really, really important to do that, because you're not going to get LNG exports, like the long-term thing, off like your allies and the global market to accept it. With the fact that we're only, if we're exporting 12 BCF a day and the market for LNG is only 53 BCF a day, like you got to build it. So we have to build it. So we can do that. 16 BCF a day is easy, and I don't think a few BCF a day more it's not easy. But there are costs incurred on the European side, where they have to build that infrastructure to import it, and they have to maintain their natural gas infrastructure. I mean, they have it, right, if they're using natural gas. But this is why doing an energy transition, like they can't swap out that natural gas, right? They have the pipelines for it. So LNG makes a lot of sense, but they have so much more price sensitivity because they're paying obviously for LNG. So if you have a spike in global natural gas prices, they feel that. So the more LNG we get on the water, and the more every molecule that we get on the water, the more we're going to lower that global that spot price, and the more energy security we're going to have. So that the quickness and the speed and the cost, like we'll be incurring costs on the investment side, but overall, the more that's getting on the water, the better that's going to help them.
So why is China? Why are they stockpiling oil at the same time their economy is tanking? Is it because they're on a war footing, or is it?
So it's not because they're I do think they're on a war, like they're on a not on a war footing per se, like they're going to war. Yeah. They are on a war footing in that they're helping Russia with their war. They're stockpiling because they always do that, right? But it does seem like there just seem to be more in the queue right now. There seems to be that when prices are low, they were going to do it. They have the ability, as they're like, if they're actually enabling or leaning into their economic decline, it allows them to do a lot of stockpiling. So since Mao, they've only had 5 leaders since Mao, and they've all been obsessed with this securitization, right? They just don't trust markets. So there's part of that. But I do think there's something to be said about, like, when you have all the security, when you have energy security, and you have leverage, right? You're able to do more things. You have more flexibility. So what you do with that flexibility, I don't think it's like kittens and roses and daisies for China. I think it's more nefarious things, but they do want that flexibility so they can do things. Part of what they're doing right now is they're just making sure that they can actually live through sanctions, right? The fact that they think they're going to use secondary sanctions means that, one, they're invested in this war for the long term with Russia, or they're willing to do that. They think they're going to get sanctions slapped on them, so they are trying to get their gold reserves up, which I had to take that slide out. But everything they're stockpiling on, and food has been something we've really seen going crazy. Also, that's like government down, top down initiative. So you can go crazy when you do top down everything. That tends to be what happens in China. But when it comes to power generation and fuel, like it's a really big thing because people see them as this green powerhouse because they produce all this wind and they produce all the solar and they export a lot of it. And then it's really cheap and they're dumping on the market and they're using some of it, right? Their grid, you can see in their grid where they have like a big rise in wind, it's all power generation. But it's nothing compared to the 5,000 terawatt hours of coal, like absolutely nothing. And they're only doing it for energy security, right? The whole basis of this is them thinking that if we're using a little bit of wind and solar, we're not using some coal and we get a stockpile of that coal. So when you look at their coal, when you look at that's their power generation, and we know their economy is declining. Like that does not make sense, right? Something is off here. So they're building a bunch of stuff. And they're manufacturing powerhouse and they want to be. And they have a third of the world's power generation, 1/3. And almost all that, the majority of that's coal. Like we don't even have, we have like half their grid. And we don't even have 1,000 terawatt hours of coal and they have 5,000. And so that means that they are emphasizing affordability, like they subsidize anyway, so it's less about cost, but it's reliability. So they know coal, they have it, so it's energy security and it's reliability. And so when it's a country you don't trust and a country that we are an adversary with, and this is what they're doing in energy, it's something really important to watch because they're clearly doing things that people are not paying attention to. And building your country off of coal and electricity is amazing in the 21st century when they're a dominant coal power in the modern era, and people just really are not appreciating it in that vein. So they're definitely stockpiling crude oil. It's not just because they're thinking about things that they're trying to be insulated, and they definitely think that they want energy security. So if they stockpile a bunch of crude oil and they're starting to use less crude and they get more EVs, they just have a lot more flexibility if they want to do a skirmish or if they want to do something, a blockade in Taiwan, or just even something short term or like engage in something. They have much more flexibility than they had 10 years ago. Questions? I'm really sorry about the U.S. shale, so if you need to ask questions, go ahead.
What's going to happen with fires in California to California's economy and the nation?
So I think like fires in California, obviously incredibly sad, and the loss of life, that number keeps going up. So that's absolutely devastating. But I think from like a market perspective, it is inflationary. You're not going to be able to build. I mean, the average home price is like $3 million because you got some $20 million homes. I think the house from Succession, the show, it's burnt to a crisp. That was a $124 million house. So like the insurance things, like you are hearing people dropping coverage, like insurance isn't covering this. But really, it's going to come down to permitting. So all this stuff's burnt to a crisp. People have to permit this. It's going to be years of permitting, let alone building. So I mean, I think the inflation is going to happen because you're just going to need a massive amount. This is really expensive homes, really expensive, like to rebuild all this stuff. So that's going to be inflationary. And then it's also insurance. Insurance is going to ratchet up costs like crazy and try to get that money back somehow on the ones that they are paying out with. So like immediately on face of it, absolutely inflationary. But like in terms of, are they going to be able to rebuild? Not quickly because it's California. And so these folks, and this is sad to say, but you want to state already Gavin Newsom has said they're going to do permitting reforms. And try to make expedite permitting to build these homes. But if your average price is $3 million, there's a lot of poor folks that have not, that have a $500,000 house that are just out. You're already hearing about people coming in and buying land like crazy, or trying to buy land and buying on the cheap and saying, because if you're not getting the insurance money, they're just trying to buy the land. And some people are taking it because it makes sense for them to say, I'll just sell this. And you already hear people in the state saying, oh, that's horrible, because they're screwing people over and land value is going to go up. Of course they are. That's why an investor is going to go in there and they're going to say, okay, at some point this will get better and we'll clean all this up. But it's a lot of money. It's going to take time and permitting reform. And I think this is going to be an absolute mess. And it's going to be really difficult there's a lot of money there. So the folks with money, it's not a big problem. It's everyone else who doesn't have the money that had a home, or that they had a lot of wealth in their home and now that wealth is gone. Yep.
I have a question. You were talking about geopolitics and coal. What can we do as oil and gas industry in Colorado to help, shore up that power? Do you think there's something we can do?
I do. I think the oil and gas industry in Colorado needs to do a much better job of actually maybe just talking about the industry, defending the industry, educating people on the industry. The oil and gas industry in Colorado, I'm very honest about this. I know I get criticized by a lot of industry leaders, and they disagree with me. But no, they haven't in Colorado. The industry has not stepped up. They're starting to now. They're starting to play offense instead of defense. But the industry has been on defensive mode since Polis came into office, hoping that if they have dinner with him enough and whatever, I don't know what they say to him at dinner, but hoping that if they do that enough, that he's just going to agree to give them what they're, whatever they want. They're not going to get anything from Jared Polis, right? He's going to say what he wants to everyone else, say what he wants to you at dinner, and then he's going to go do whatever he wants. Because he's just about moving himself up. So the industry needs to advocate for the industry. Like, they need to be talking about this stuff. More of this needs to be happening across like a broad base. Like, when I talk to other stakeholders, when I'm doing this with Common Sense Institute, when I'm talking about leaders in Colorado, they crave this intel on what's going on with energy, what's going on with electricity. Like, no one has this. So oil and gas, particularly in Colorado, I think really needs to be talking about the natural gas price delta. The fact that maybe if you're Chevron or maybe your company here, last year you were getting probably 30 cents an MCF, and yet what people are paying for natural gas from Excel, that's highway robbery. And so we talk about, Biden wrote letters to Exxon and Chevron during post-COVID saying that they should have been passing on the savings of oil prices to the consumer because they weren't moving down quickly enough. Like, oil is the only thing that moves up with inflation and down. Like, when oil prices go up, people feel it at the pump. When oil prices go down, people feel it at the pump. There's not a lot, refining is not a high margin business. Natural gas, people should be feeling a deflationary pressure in their utility bills, and they are not. Or at least if I have natural gas piped into my stove, I should be able to feeling that. So this is what the industry needs to talk about, is we're producing all this natural gas. You're producing 7 BCF a day or 6 BCF a day in Colorado. How come that's not getting to savings to the consumer? And it's becoming unaffordable to live in Colorado. We have plenty of energy production. We produce 500,000 barrels a day. We could be producing a lot more. I mean, when you look at this of like where, and I put this in this Common Sense Institute report of where the U.S. growth in oil production has grown, where Colorado is. You stack up all these states, and what's really amazing is that that's Permian, 9 million barrels a day from New Mexico and Texas. That's as much as Saudi Arabia. That's incredible. But then you look at Colorado. So that's California and Alaska. That's what you don't want to do. That's a terminal decline. And this is Colorado, where we're stuck here, where we could be producing so much more, especially $80 oil, but we're not because of the regulatory environment, because you cannot get a permit. And then what you've had, and I'm going to call them out, but Oxy and Chevron are big companies. And what they've done is they've not wanted to do, and I say this, and I'm being honest, but I don't think within KOGA or other entities, they probably wanted to fight the big fight. They haven't wanted to be vocal because I don't know, they had permits in the queue, and so they didn't want to piss anyone off. Well, it hasn't really helped anyone. So Oxy and Chevron have a lot of permits, but nobody else has permits. So maybe if we had advocated for the entire industry and the whole sector and not kowtowed to everyone and pushed back and said this is bullshit, maybe we wouldn't be in the situation we're in. So I think the big companies need to stand up and start. And Colorado needs to have something like New Mexico, where the independent producer association, the smaller companies also have a voice. And actually you can play good cop, bad cop. And I love that Oxy and Chevron are here. I'm not demonizing them, but I think the big companies, we need small companies as well. And this is case in point. When you look at the actual wells, Colorado, they are atrocious. And I pulled them up and I was looking at them, and it's we have more rigs in Uinta than Colorado. We have no activity in Colorado. This is your well completions. And this is what happened after you passed the SB 181 or 119 legislation in 2019, SB 181. This is what happened to your wells. We're just not completing wells. And so this is a story that I think it's taken these companies a little time to realize that, yeah, they've been on the offense or the defense and they need to play offense, but it's kind of, it's a little too late. So I think the industry needs to heartily push back and also educate, and doing things like this really, really helps. But I'd like to be able to do more of this outside of the oil and gas sector and more to just business leaders and folks in Colorado and elsewhere to just educate people on energy. So sorry, I'm a little passionate about that.
Good for you.
Thank you. Are we good?
Any other questions? Well, thank you so much, Trisha. That was fascinating as always. We have a little gift for you. Thank you. And there's flyers on the table for everyone for our upcoming events. Looking forward to seeing you there. And thank you, Trisha, for coming and speaking.
Thank you.